I will start us with some of the corporate highlights, which will include basically, a quick background on who we are, what our main business, as well as move on towards our performance highlights, and then, the latest updates in terms of our M&A, and then we can, open up the floor for the Q&A, which Paul and myself, will be happy to take us through. Yeah. So moving on to the corporate highlights, I think if we look at our track record, amongst the Indonesian coal producers, so GEAR, as Luke rightly pointed out, since we last met up and had this together with Philip, was 2017. So since then also we've been very proud to say that that time in 2017 our coal production was only on about 7.5 million. So we were only doing about 7.5 million tons, and since then we have grown strength to strength, and in fact we are the fastest growing Indonesian coal producer. So we have increased our coal production all the way to in excess of 30 million last year. So this was even on the back of when coal prices were starting to come back, and even when coal prices even did come down. In fact, we have a stellar track record of being one of the coal producers that year on year continue to increase our production. I'll share with us later on as to what enables us to be differentiated from our competitors, and what sets us apart. So diversification is very important. I think since we last met up in 2017, GEAR has also been very active in terms of, I would say, the M&A front. Firstly, in 2018, we had gone into investment into West Gold, one of Australia's top 10 gold producers. And in the last 6 months, that time I remember when we invested, gold was maybe about $1,300. And in the last 6 months, you have seen gold actually gone up from $1,400 to $2,000, right? So we took the buoyant prices and the opportunity to also divest our West Gold. That being said, we are very intentional. I think our diversification plan continues in Australia. Why Australia? Because Australia is within Indonesia's backyard. It's plus minus 2 hours. You can see it's within basically the same time zone and region. Again, Australia being established legislation and country with a stable jurisdiction. This was why Australia was natural for us in our expansion. Of course, we are all aware that up to 2017, we are just a thermal coal producer producing out of Indonesia. So our sovereign risk was only but 100% reliant on Indonesia and one product, which was thermal coal. I think since then, in 2018, we have branched out to gold, and also of late, we have just in May this year completed the acquisition of Stanmore. So we have diversified successfully into coking coal. So coking coal is slightly different from thermal. Thermal coal is coal that is burnt for the supply of electricity and power. Coking coal is for the manufacturing of steel. So for coking coal, there are no substitutes, unlike thermal coal, whereby you are able to substitute with gas, with oil, with renewables. So it was really important for us as we chose, a stable jurisdiction like Australia, as well as, the right product mix. Of course, being a coal miner, coal mining to us is already something that is within our expertise. So this was the key reason why we continued to diversify into something which is within our key strengths. Both Stanmore and Ravenswood are all in I would say in Queensland. So very close operations, very close to one another, and we see a lot of synergies with the head officers operating out of Brisbane itself. On the next slide, basically sets out very clearly, how we have grown. On the left was our GEMS, which is IDX listed, Golden Energy Mines. This was very much the main asset since our reverse takeover of Unifiber in 2015. And since March this year, I have completed Ravenswood Gold. So together, the other 50% shareholder of Ravenswood Gold is EMR Capital. It's a leading and well-known mining fund that used to be the ex-owners of Matabe Gold. So from a 10% stake in West Gold, which we have substantially sold off, we have gone up the learning curve, I would say, to operate on a 50-50 joint venture basis with EMR, a leading mining fund, which has experience in gold. Stanmore itself, we've completed in May this year. So the general offer was also successful. This was the first time that we had conducted an on-market bid. I remember when we launched on the general offer on 2nd April on the Australian Stock Exchange, we were able to do this fully remotely, and we ended up with 75% as at 18th of May, the close of the offer. And in fact, in our latest results, you'll be able to see a little bit of the consolidation, bit of May and June, and the balance sheet. Yeah, so in short, Gear has really transformed itself, and in terms of even transparency as well as corporate governance, you would see that Gear being Singapore listed, GEMS Indonesian listed, and Stanmore Australian listed, you would see really a great deal of harmonization of the various rules and regulations from the stock exchanges, and to a great degree transparency. On the following slide, just want to touch on really what is enables and what's the key competitive strength in our thermal coal first, as compared to a lot of our competitors. That time, I think even in 2017, while we were even the Singapore Stock Exchange largest coal producer, we had competitors that were close by with us, I think also producing on or about 7 million tons. But I think how we set ourselves apart from our competitors is really our operational excellence, as well as the logistics infrastructure that we wholly own. One very key thing is our ability to be able to manage our cash costs. And this is really possible because of our low strip ratio. So strip ratio for us, in simple layman terms, is the amount of overburden that we have to remove to get to the coal seam. So that will basically be a key determinant of the cash cost. So how deep is your coal underground? Yeah. And the next thing, another key factor will be the logistics. Some coal mines in Indonesia, in Sumatra, in Central Kalimantan or East Kalimantan could be 400 kilometers inland. So what happens is that they may need to haul the coal from their mining pit 150 kilometers to the river, a port in the river. Then after, load it onto a small barge, because larger barges are not able to go so upstream. And then from a small batch, you'll transship to an intermediate stockpile, whereby it gets, again, double handled to a larger batch, and then the larger batch to the mother vessel, which is at the sea. So for us at Gear, it's a very simple process. From pit to port, we are very proud to say it's only 25 kilometers, and our port is not at the river. What you see at the bottom right in blue is the Java Sea itself. So that's the seafront. Yeah, so it becomes so simple, whereby pit to port logistics is only 25 kilometers. And you can see that picture is our expanded port. I remember a couple of years, we took some of the analysts down also, down to visit our port expansion plans. And since then, we're proud to say that we have a port capacity of in excess of 44 million tons. So what has really set us apart from competitors was that we had always invested our capex, capital expenditure, on a modular basis in advance. So our infrastructure would always be able to support the production growth. So, many would also be asking as to, wouldn't this be, wouldn't you want to wait for coal prices to come back first, before? I think the key thing is this: when coal prices do come back, I remember in 2016, Newcastle was about maybe 48 50, yeah, and in a short 3 months it was back up to $100 yeah. So the tap, to quickly turn on the tap, and that ability, that is what basically gear has. Yeah, you can see the whole logistics chain from the stockpile to the haul road to the coal handling plant, the barge loading, as well as the Java Sea where we go straight to the mother vessel. We own and operate everything. So that it basically dedicated wholly to our production, and whereby we have full control. We are able to ensure that vessels are not waiting at sea, and to minimize our demurrage costs, as well as to support our ramp up should when coal prices do come back. So I think for next on, I'll move on towards our performance highlights in this first half of the year. So I think we've had very proud to highlight. I think with the first 3 months, really we've seen our good buoyant coal prices still. Before COVID really fully set in on second quarter. So on the back of this, our first half results again was another 30% increase year on year compared to the first half of last year. So you've seen us last year doing about 30.8. First half this year we are already at 16.5. Yeah. So I think the key thing was really, despite coal prices going lower, average selling prices lower by about 7%, we were still able to register a record first half revenue of 600 million as compared to 500 million last year. So domestic sales was one of the key reasons also, that we were able to continue to increase our coal production. So I remember in 2015, when coal prices were also down, we did maybe about 55% domestic. So, again, our coal goes to the country that pays the top dollar for it. So the key thing is that when coal prices do come back, you will see an increase in export sales. When coal prices soften, you will see us doing more domestic sales. The good thing about us at Gear is also 90% of our coal is low to mid CV, whereby we're doing about 4,200 GAR. So this quality of coal is not only limited to specific markets. For example, your Japan, Korea, and China. This coal is very versatile. It goes to your Southeast Asian countries like Vietnam, Cambodia, Philippines, as well as Malaysia. In addition to the traditional markets like Korea, China, and India. So you see us, basically able to move our product. So that's why we do not need to be in a position whereby we have to reduce our production. So what enabled us to also have good, strong profits, I think, in the first half of this year was really our strong ability to manage our cash costs. So you can see that we have managed our cash costs by on about 4.4% to about $22.5. Yeah, this is very important for us. Even on second quarter as compared to first quarter this year, you will see that we have really done another 10% off, quarter on quarter and year on year. I think the key thing was really three key factors. One was lower fuel rates, a lower strip ratio, as well as us being able to manage our contractor rates. I think this is very key. During a downtime whereby we've seen in the past when coal prices are very soft, a lot of the other coal owners and producers, they turn off the tap. They stop the relationship with the contractors. But for us at Gear, it's different. Because of our low cost structure, we're able to give our contractors even more work, even more contracts, and stood in between them and their financiers for their heavy equipment purchases. So this enabled us, even when coal prices to come back, we are able to turn the tap back on very quickly, and even take advantage of the relationships. So it was a natural partnership and good relations between our contractors and us. So on the back of this, our EBITDA and net profit surged, I would say, 30% to about $80 million. So on the balance sheet side, cash balance has increased, while our leverage ratio has remained fairly stable. So I would say that this balance sheet is also the first time whereby we are consolidating Stanmore Coal into our balance sheet. So you see that basically gear has really transformed, yeah, not just in the form of taking a passive investment, but really having a key operating subsidiary with a different product mix and an extended sovereign risk to include Australia. We had also taken advantage of the buoyant coal prices in first half to divest quite a great deal of our West Gold resources, which we invested in 2018 for profits. So this had all contributed to the first half performance this year. I think on our diversification, this was what I highlighted, was really that we have moved. West Gold was our first gold acquisition and baby steps into gold. So that time we had 10% and one board seat. Yeah, I think since then now, together with EMR, the ex-owners of Mata Bay, we have been increasing our involvement in gold, whereby we are running this on a 50-50 JV basis. Yeah, and of course, Stanmore, which I've highlighted earlier. So our the key direction for us, going forward is really to reduce our earnings dependence on thermal and continue, in line with our vision to be a leading sustainable energy and resources company. Many people was always joking, right? Hey, golden, you say you're golden in that time in 2017, but there's no gold. Yeah, but I think we've fulfilled that. We continue to look out for such value accretive acquisitions. And I still remember when we in 2018, when we launched our first high yield bonds, and we were also rated by international rating agencies such as Moody's and Fitch. We were given a B plus rating by both of them. And I remember that even with COVID right now, a lot of our other competitors in Indonesia, some of which could be also listed, in the Singapore Stock Exchange, a lot of them have had their ratings to be downgraded because of earnings. But I would really, we are very proud to highlight that, Moody's and Fitch has reaffirmed our ratings at B1 and B plus, mainly because of our successful diversification, whereby we are not reliant on a single product as well as a single sovereign risk. So we continue to look out for this transformation. So this is a snapshot of what I've highlighted earlier. Basically, we can really see the ICI 4 price trend, whereby, since December, it's gone all the way down to $25 as at June, and it's also still facing subdued pricing as we speak, on about $23-24 now. But the key thing for us is that even during these tougher times, we are not too affected. The key thing is really our ability to manage our cash costs. That's why we are able to increase our production volume, as you can see from the production table on the right. Even on a half year, we've registered another 30% increase. So like every other coal producer, I would say that we are a price taker, but the thing is, again, with so many vaccines and so many, we won't know when the turning point is, and when global economies recover. The important thing is we are well poised to be able to take advantage of that when it comes back. So on the group financial performance, this was highlighted earlier. Even despite drop in average selling price, we're very proud to highlight that our EBITDA has gone up. Even on an EBITDA per ton basis, has remained stable from 4.8, slightly increased to 4.9. Yeah, and the group is strong in terms of its cash and its leverage ratios. So on this revenue by geography, this was something that I wanted to bring up. How I guess really towards the current COVID, how is demand for coal changing? Yeah, I think it's very key that from day one, we were not dependent on, one certain market itself. And this is really reflected whereby, during this season when India had came off, you can see India has come off 23% to about 13%. But this was really, balanced out by our increase in sales to China as well as domestic. We've also increased Philippines sales. So of late, recently we've also read articles whereby Vietnam was #1 in thermal coal imports in Southeast Asia. I would say that for countries in the Greater Mekong region, very much that because for the production of power and electricity, cost is still the #1 factor, and nothing changes the fact that coal is still the cheapest, in the form whereby you do not need large capex, and you are able to tap on that source of power before you even move on or to talk about renewables. Yeah, every country needs to have a key baseload of power. So on the corporate developments, I think I'd like to give a quick summary of how of Stanmore itself. So Stanmore, it's only producing 2 million tons of coking coal. I was always joking with management. In the past we maybe did 30 million tons at GEMS, and then we had 100 million of US EBITDA. Stanmore maybe produces 1/10, yeah, but EBITDA for coking coal is very robust, whereby just from you look at the fourth bullet point, from in the previous year, when ended June 2019, Stanmore only produced 2.4 million tons of coking coal, and their EBITDA was 154 Aussie dollars. So that is what we are looking at, looking for the high value accretion. We like investments, and Stanmore was one of them because it had zero debt. It was in a net cash position, and it had very strong earnings. So for us, I think I would say that it's been a good time for us when we launched this general offer to increase our stake in the midst of COVID. And of course, coal prices has come off a great deal since then. Yeah, so it would have been a good window for us to consolidate our position in Stanmore. Next up was a summary of our Ravenswood. So Ravenswood itself is used to be owned by Australian listed company called Resolute, and Resolute had 3 other gold mines that were in Africa. So Ravenswood was one of their non-core assets. So they had put it up for process. And this was when, just end of last year, I remember I was basically together with EMR, we were flying down, to Townsville, just on the north part of Queensland, yeah, just south of Cairns. So Ravenswood itself is already a producer of gold. It's producing about 60 kilo ounce every year, and we are in the midst of doing up the job reports, as well as a bankable feasibility study for the expansion plans. So basically, what we are looking at is, to increase their processing facility from 5 million tons per annum to 7 million tons per annum. And if you look at the existing JOC resources, you're already looking at 2.7 reserves, 2.74 million ounces of reserves. Yeah. So one would ask, hey Mark, how do you best value, gear? You've got so much. I think do a sum of parts. If you look at Ravenswood, in terms of its production, in terms of its reserves, the JOC reserves, and you compare it to the other list codes, I think you'll be very surprised to see the kind of value that is inherent even in our investment in Ravenswood. So for Ravenswood, we were also very blessed. It's about timing. I remember closing up this acquisition sometime in just Christmas Eve last year, and we signed off 15th of January this year. That time, gold was maybe 1,004, yeah, and it's gone up $600 in 6 months. So we've had a good run, yeah, amidst all this market volatility. So fingers crossed, you know, we will be able to and continue with the expansion plan and to, you know, get the EBITDA, you know, from Ravenswood also. I think it's very intentional from us that to include gold into the portfolio, so that gold is a counter-cyclical commodity. So while coal is taking a breather and is having, you know, subdued pricing right now, gold is shining, right? So for us, the good thing about gear right now is that being diversified, you know, with a counter-cyclical, when gold prices are good, we'll try to ramp up our production, increase our EBITDA from gold, and then towards coal, there could be opportunities for investments while coal is soft at the moment. Yeah. And then of course, when coal comes back, gold could still remain, right? So that is our key strategy that we have. And I'll just hand over back to Paul. Yeah.